Hi, welcome to the Art of Investing. It's August 23rd. Let's go to the market evaluation. Start with the Federal Reserve Symposium on Friday. We talk about Walmart, Cracker Barrel, and Plantier. Let's start. On Friday, Federal Reserve held up the symposium and discussed different economic factors from interest rates, inflation, tariffs, and other economic factors there. The main outcome for the stock market was the hint of rate cut. When the interest rate reduces, like it helps to boost the market, and we have seen that on Friday there was a increase in the market. S&P 500 was growing, and that was the factor of the hint of reduction in the interest rate. Interest rate, Federal Reserves use the interest rate to kind of like help the economy, the whole economy. That, and when there is a recession or there is a slowdown in the economy, they try to reduce the interest rate and pushing the economy to go faster. When the economy is growing fast, the inflation is high, they try to break it with the interest rate. And some people think that they are controlling the inflation rate, but it's the other way around. Actually, they are following the inflation. They are following the inflation in the way that when the inflation goes high, they try to increase slowly the interest rate and control the inflation. And we have seen during the last few years that was going higher, the inflation rate was going higher, and that caused the federal rate to involve in and increase the interest rate. It causes difficulty on the buying the houses, and the home market is getting difficult, and that's also the pushing from the White House and the president, because they want to also give a boost to the economy. But Federal Reserve also wants to be conservative as well, because if they do it very soon, similar to what happens during the 1970s, it could be double inflation, or there could be multiple recession happens. Then they are kind of like evaluating different factors, like in the like we know that like the tariffs also affecting now, and different economic factors of unemployment, and those could also affect that. But we expect that, and they gave the hint that they're going to reduce the interest rate in September, which is good for us. The stock market goes up after that. Let's look at to the stock market for the last week. As we expected, and it was continuing on, the technology sector was slowing down and going down. The finance and healthcare sector was doing good, actually. They were increasing. Looking for the monthly check, like there was a mix of that, and almost like S&P 500 growing in the last month, and the technology was slowing down, but still for the last year they had a good growing and gaining. And if you look at that one, still they are gaining for the last year about 14%. They were at highest 25%, if I remember correctly, and they were going down for the last few weeks. But it's kind of like a breathing. When you breathe in and breathe out, when they go very fast up, they need to slow down for a time, and then they go up. You have heard the news, oh, the recession is coming, and like different news you may have heard, but it's not because of that. It's kind of like going up and going down. And the market is always like that. It goes up and down. It doesn't go straight up. But still not very like crazy factors coming to the market. And let's look at to some of the stocks itself. Plantier Technology. You may have heard that Plantier is very good growing company. It's gonna be boosting very fast. And we need to get the stocks. It's very good stock to buy. We're gonna evaluate that one. Plantier itself is a software company giving the services to the company and to the government and commercial companies, and it's growing up. Actually, you have seen that like they had a good growth up for the earning and cash flow during the last years and few months on that. And but we need to look at two different factors when we are looking to the for one stocks. The selling price at this time is $156, and when we evaluate the intrinsic value, we can use different methods: P ratio, PS ratio, discounted cash flow. I usually prefer the discounted cash flow better because it has different factors in that. It doesn't mean that like this is the best, but like it has different factors, and I usually prefer to go with that one. But let's go to the steps of the evaluation. We don't just look at the value itself. Palantir has a good business mode. It means that like they have an opportunity to uh, like control the pricing in the market. I mean, the business mode is 7. I prefer usually go 8 and higher, but 7 is good. Revenue is growing very fast. This is very good. The cash flow was kind of like mixed. It's growing, but it was growing very recently, and they expect it to grow very fast during this time. And the current ratio is very good. They have very low debts, and they have a lot of cash. The discounted cash flow intrinsic value is about $60. It means that it's very overpriced now, and I don't suggest to invest in it at this time. I know it's a good company, it's growing, but you can wait until it goes a little down, and then you can invest in that. Like people say, okay, it's like Nvidia, and like I mean, it's gonna go very fast, and we're gonna lose that. But even Nvidia was going up and down on that one, and there are times of opportunity to invest in these companies. Let's look at a completely different company, Walmart. Walmart is a defensive company, like defensive stock. You know, Walmart is a general store. It works like during different times when the economy is good, it works. When the economy is bad, people need to get their basics anyway. They have a good high moat in the market. They can control the price. The tariffs recently has like some like effect on the Walmart earnings on that one, but I would say this is gonna happen for all the stores. Like different stores gonna see the same thing on that. Their revenue is going up very well. The cash flow was mixing, but yeah, that's something which I don't like it. And the current ratio in the PEG is not very good, but I would say the more important is the discounted cash flow or the intrinsic value. The intrinsic value that we get for this is about $30, which means that uh, this is going to be showing very higher compared to uh, the intrinsic value of the stock. Oh, these diagrams actually I get it from the Guru Focus. It's very good website to get those, but it needs a membership and pricing in that one. There are other software also I'll introduce in other videos, those other websites that you can get these information. But I like Guru Focus because you can combine everything in one place, and it's very nice. Now let's look at the Cracker and Barrel. We have heard in the news that they are changing the brand in there for the Cracker Barrel. Cracker Barrel is the restaurant. They usually like very good environment, the counter look environment. They have a small store on the side, and when you go there's a completely different environment compared to the other restaurants, and people like that one. When they're talking about their rebranding and changing that one, people have the feeling that it's not gonna work out very well. But let's look at the stock itself. The business mode is 5. Like I usually go to 8 and higher, but like for the restaurants, business mode is very difficult. There are lots of different restaurants. It's very hard to compete in that environment, and I expect that okay, this is the business mode is gonna be small. And also, like I usually don't invest in these companies because they'll need a lot of money for investment for the comeback, but also in different areas. Like when there was a COVID, they were very like losing their earnings at the time. But the business itself, they're growing. The revenue is going up. The cash flow is mixed, and the discounted cash flow is kind of like similar intrinsic value. It means like the price is fair value. It's not high, very overpriced, or it's not very underpriced. It's kind of like fair value there. And oh, here I want to just compare two different areas. Like, I mean, one Google in technology, or like the company, which is completely different than the restaurants in the Cracker Barrel. Usually, when we go to the like the market, like Google, Meta, Apple, the business with the large moat and very high moat, they have a lot of income. They have a good opportunity to get a lot of money through their investment on that one. They have some expenses on that one, but the main part coming in the income. When the moat is small and when we go to the large competition with the other companies like Cracker Barrel, lots of other restaurants is the same. They 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 have a very marginal uh, growth because of, like, I mean, the very large competition that there is in this market. You can see also, like, they go to the lot of depth on that one, and compared to company like Google, and the depth means that, like, they are very also dependent on the economy. When the interest rate goes higher, it's harder for them to go to the depth and paying back on that one. But the companies like Google and like Apple, those companies usually they control on that. They have a lot of cash, and Those are the markets I usually go through. That I try to go with the stocks with the higher moat to be able to control the price and be able to get the growth as they get through it. And with this one, I want to close up the this week discussion, and we're gonna discuss about other uh, earning news for the next week. Nvidia is the biggest one. We'll go through that next week, and may your investment flourish. See you next time.